good to see you as well. Even though with the schedule change, I'm glad I'm behind you. Yeah, it's kind of funny, actually. It's not surprising. I almost was broadcasting from Heathrow Airport. I was stuck there. If you all heard about that situation in London, I was stuck there for 5 extra days. Ugh. Which was horrible because the weather was so bloody cold that I couldn't even really enjoy the city. I would go outside, and after like 5 minutes, I feel like I was going to die. My South American blood is just not prepared for that weather. So yeah, I was actually holed up in a hotel for 5 days. No fun. But I got to get a lot of good business done and things like that, so yeah. How's the sound on your end over there? Hello, Vicky. Hello, Maud. Good to see you, too. Sound, check 1, 2. How is sound on your end? Sound is okay? Okay, fantastic. Great. Felicia, you want to wave? What's everybody? So normally on Tuesday we're doing an Ichimoku class. This is not an Ichimoku class. This is a class on price action trading. And part of that is because there's some big changes going on for me and my work. I have about 4 or 5 new projects that I'm working on that are far larger than Second Skies that it was ever designed to be. Second Skies in itself was, Second Skies has been a great project. I'm really glad I've been involved in it. I've been able to work with a lot of traders and help a lot of traders become profitable. But if Second Sky's goal was about building a street, these new projects I'm working on are about building an entire city. They're huge projects, and when the time is right, I'll be making the right announcements. But because they're so huge, they're going to keep me very involved. So I'm going to be teaching less classes. I'm going to be doing a lot less things like that because I'll need extra time to devote to that, to these new projects. They're going to be quite engulfing in terms of my time. So yeah, I won't be teaching 2 classes a week. I'll just be teaching 1 class a week. But for the things that I will be involved and I will be creating, I think they're going to have a huge impact in the market. So I'm looking forward to being able to announce these at the time is right. Carl says, Chris, forecast of snow for next week, also snowing today. Hope you're looking forward to it. Thanks for the warning there, Carl. Carl's warning me because he knows I'm coming back to London for business. Luckily, I'm not coming back next week. It's the week after, I think. Yeah, next week, I won't be here. It's the week after. I will be back in London for a couple of days on the 17th. You know, it was funny, actually. Maud and Vicky might appreciate this. I had to change hotels because I had scheduled, I was in one hotel, and then I went to go to the airport to get my flight, and then when I checked out of my hotel, when then the flight was canceled, I was leaving on the first day, I think, that there was cancellations. So my timing was awful. But, so anyways, my hotel was full, and I had to get a new hotel room. And I ended up staying at the Montcalm Hotel, which is a nice 5-star hotel in near Park Lane. But the concierge there had actually been coming to these FX Street webinars for like 2 years or something like that. So when they saw me, they asked me, like, are you Chris Capre? And I said, yeah. And they said, we've been coming to your webinars on FX Street for the last 2 years. And I just thought it was the funniest thing ever. So we took a picture. It was super entertaining. So yeah, FX Street is everywhere. And it was kind of nice to be in a hotel and kind of a pseudo-celebrity. So it was funny. After that, everybody started calling me Mr. Capre in the hotel. Very entertaining. But anyways, so this class, I'm not doing Ichimoku probably at least for 6 months, maybe an entire year. Why? Because I've been doing Ichimoku for 3 years now. And I'm going to be going into a new research mode in it. And I've been teaching it for so long, I'd like to take a little bit of a break from it. But price action, I've only been teaching for, I think, about 2 months now, maybe 3 months, during the Tokyo session. And we thought we'd bring it back into the main time slots for everybody here. So for those of you that were in my price action class before, this is relatively going to be a continuation of it. We'll be talking about a few different extra things as well, but for the most part, it's going to be really trying to open up the world of price action and give people a new way to look at this particular method to approach the market. So thank you all for your patience and the adjustments and everything like that. Okay, so is there anybody here that has never been has either A, never been to the price action webinar that I taught on the Asian session last year, or B, has never studied price action at all. So maybe you've never been to the webinar, but you've studied price action. If you're that person, that's fine. Say I'm an A. And if you've never even studied price action period, just say, hey, I'm a B. Just so I get an idea. A lot of the names a fair amount I do recognize, and so it's good to see you guys back. But I also want to see, because I'm also seeing a lot of new names, and this is a slightly different time. So a lot of people have never been to my price action webinar, but they have studied some price actions, a lot of A's, and then a few B's in here. Okay, so that means they never studied price action as a whole. Okay, fantastic. Well, let me turn the air conditioning a little bit. It's bloody hotter than hell in here. It's unbelievable. The funny thing was the day I left London, it was like one of the coldest days they had since 1910. And then when I landed back in Buenos Aires, it was like one of the hottest days they'd had in December for like the last 50 years. So, and it was funny because I couldn't leave my hotel in London because it was so cold. I felt like I was going to die. Every time I was outside for more than 15 minutes, I thought I was going to die. The worst part was when I had to go to Scotland for a day. Then I really felt like I was going to die. But, yeah, so anyways, then I get back to Buenos Aires, and it's so bloody hot I don't even want to leave my house because it's the only place I can get constant air conditioning. It's hysterical, so eat Aggies. Nice. Okay, so good. Well, it seems like we have a lot of people here that have studied some price action, never been to my webinar, and some people that have never studied price action. So let's talk about this here. When I talk about price action, the simplest definition I can give is talking about prices movement over time. However, that doesn't really encompass what we're going to be talking about. But the point I'm trying to make here is that a lot of people think price action is equal to candlesticks, and it is not equal to candlesticks. It's very different than candlesticks, and we'll talk about why it's different. When I'm talking about price action, I'm talking about prices moving over time, but I'm really talking about two important things within that definition. I'm talking about A, the structure of price on the chart. And when I talk about the structure, I'm talking about all kinds of variables. I'm talking about the open and the close and its position in relationship to other open and closes, the wicks, the length of them or the shortness of them, the size of the body. I'm also talking about the structure of the entire series of moves, impulsive or corrective. I'm not talking about LOE, I'm just talking about impulsive or corrective. And the other thing I'm really talking about when I talk about price action, those are just some of the variables, but the other thing I'm talking about is prices movement over time, because price is moving not in a vacuum, but it's moving in time. And the amount of time that price has been moving in one particular direction or another signifies a lot. It communicates how consistent and how strong the buying pressure is or is not, the selling pressure is or is not. It communicates that there is either no real battle going on between the buyers and sellers, there's a clearly decided winner, or there is a battle going on. And we can see that not just through the physical structure, but we can see that through the time. Because the bottom line is people have to participate in the market, but they're not just participating in a vacuum, they're participating in time in the sense of many institutions are buying and then buying again, selling and selling again. And on top of it, let's say they buy and decide to turn something around. Well, if somebody else sees that, hey, this has been holding above a certain support level for a certain amount of time, they're thinking about the market in time, not just in structure. They're saying, wow, this has spent 4 days above it. It hasn't been able to break below it. Maybe this thing's going to turn around. So institutions are looking at price action not just in relationship to structure, but also in relationship to time. And the final point is that when looking at price action, we're not just trying to look at components A, the price action structure, and components B, no chart yet. Sorry about that. Didn't really need a chart, but that's okay. So we're not just talking about the component structure A and prices action over time B, but what we're trying to do is take those two, bring them together so that we can get a picture of what the order flow is behind that kind of price action. Why is that? Because the order flow is what drives the market. It does not matter whether it's a technical or fundamental reason. It's a completely irrelevant argument, whether it is or is not. What matters is that there is people buying and selling, and it's because of that buying and selling that drives the market. And if there weren't that buying and selling, there would be no driving of the market. There would be no price movement. That's why right before a FOMC meeting or something like that, doesn't matter, or a NFT meeting, there is very little buying and selling, and so the market doesn't move. And so what it means is that we are trying to use these two components to understand order flow, because once you can look at price action in relationship to time, once you can look at price action in relationship to structure, and then you can put those two together, you can synthesize those two together, and then say, hey, the order flow behind this is the type of order flow behind this that would have created this kind of price action. Once you can start to glean that information out of the chart and out of the market, then you're really understanding what the market is most likely going to do, how to trade it, and how to get involved. So the whole goal of price action should not be to just be reactive. Oh, well, I have this formation, I'm just going to trade this, or I have this and this and that. It's to understand the order flow behind it. We're only looking at price action to understand the order flow behind these moves, because once we can understand, then we can really make a trading decision. Does that make sense to everybody there? Yes, no? Because I just talked about the basic underlying theory of how I approach price action, which in essence, I think the way I approach price action is slightly different from the other price action traders out there. Most of them are in fact, pretty much every single price action trader I'm looking out there is just focusing on structure, and they're not focusing on time, and they're not even focusing on order flow. They're not even thinking, what kind of order flow would be behind this kind of move or could create this kind of price action? I never see any one of them commenting about that. I never do. And that's where I think it's a little bit different. So Rex says yes. Yayoi says yes. Harley says yes. Okay, fantastic. Okay, great. So will I be going through different pairs too? Yes, I will be going through several, and hopefully we can get through many throughout this class. So, okay, a couple questions, and then I'd like to, or one question so far, and then I'd like to get into Manoj. He is someone who follows price action trading. Manoj says, Chris, does price action as you teach it work in other markets other than Forex? Absolutely. Why wouldn't it? I'm teaching you how to read price action. I'm not teaching you how to specifically trade one instrument. So absolutely. I use this to trade commodities, mostly precious metals, and oil. That's about it. I don't really use it to trade anything else. I use it to trade indices. I use it to trade everything. But I'm not really active in the other markets as much. I'm active in commodities, but I'm not really active in indices too much. I'm more active in commodities than anything else. I do indices when the time is right, but the bottom line is I get such good liquidity in Forex that I can, that I trade it for that. There are some select stocks that I trade, but only stocks with high amounts of volume and shares and liquidity in them. Otherwise, I'm not interested. It's probably because I got spoiled really starting with trading currencies and trading with such good liquidity that I really don't like trading things with low liquidity or even medium liquidity. So yeah, futures, same thing as well. Harley says, do I trade any futures? Some select ones, not really too much. It just really depends. I'm usually trading, I'm anything outside of Forex. I'm trading commodities and oil mostly. Mostly because my systems work exceptionally well on them. So they work really good on stocks too. There's some good stocks I trade. I like Apple and Google because they have such good, they have great volume, share, liquidity. They move really well. So I like trading those as well. Okay, FredFX. how do you determine the right side of order flow? This is an important question because the bottom line is we're not trading the left side of the chart, we're trading the right side of the chart. That's all you're ever trading. And as you can see, there is no more information here. So all we have to do is go from here back. So to do that is both simple and a little bit challenging in the sense of it's not just something that a couple rules and all of a sudden you're an expert trader. But in terms of understanding price action, let me go into a few examples, Fred. Just some basic examples. I'll show you what I'm looking at, and then I'll show you how I would make a decision based on the what I see as the order flow behind the move so far, and then how I would trade the right side of the chart. And I'll be happy to do this over several pairs as we go over this, and that should give you an idea. It's a great question. First off, the market pretty much, as we've been talking about, as I had mentioned in the interview at the ITC conference, that the euro would go up just past 142, then it would probably sell off the rest of the year and end up the year where? Between 133 and 130. And that was way back when the euro was at 140. So I basically called a 1,000 plus pip move and had the timing perfect. A lot of people are asking me how I did that. I'll have to tell you that secret another time. But the market was selling off aggressively in November. This is a massive sell-off. We have to take note of this here, and then we can start to look at the context of this move, and then we can start to look at this. It's a massive sell-off. The pair sold off literally 1,300 plus pips inside a month. That is quite drastic. One of the things I look at in sell-offs is, first of all, the strength of the particular move. As we can see, the candles are very large, which means that there was a lot of heavy selling involved in the order flow to create that type of candle. It was happening again and again and again. Anytime the buyers came into the market, they would try and prop the pair up, and then they would just get overwhelmed by the follow-up punches from the sellers. A mild, gentle pullback occurred in the market. It stopped at the 20 EMA, where the sellers said, ooh, great opportunity to resell it again. Let's sell it again. So they sold it again massively, and right after it rejected up to 20 EMA, we had the largest selling day of this entire down leg, any one single day. The pair comes down to this 130 level. Some buyers come in. Now, this is the first time that buyers really tried to challenge what was happening here. We know this because if we look at the structure of the previous move, we have 1,300 pips of selling with just a gentle pullback and then sellers adding new positions here as the market sells off. The market closes towards the low, stops on a dime, and the buyers come in and in one day completely erase all of yesterday's losses. In fact, they actually take it out even then some. They create a new high above yesterday's high, and the body here closes above yesterday's open. So this is what we call a swift change of hands in the market. A slow change of hands from buyers to sellers, or in this case sellers to buyers, will look something like this, and I'll explain why in just a moment. But this was a swift change of hands. That is not common in the market, in the sense of it's not common on the buy side for the market to be selling off so consistently and so aggressively, and then the buyers to just come in and overwhelm all the selling order flow that has been involved at that point. Now, there's two likely explanations for this. One is that as I said before, the market was selling. There was a lot of people involved on the sell side of the market. Let's say it was 30 billion short. The only way you could create a counter trend move with this kind of force and this kind of consistency is to buy it with larger amounts of money than you were selling it. So they couldn't just come in, if it was 30 million short, they could not just come in with 30 million long and then counteract that. It would not create a bounce like that. It would slow the market down, maybe stop it, but it wouldn't reverse it or push it counter trend that fast. So the only explanation is that the buyers came in with more money than the sellers were involved in the market at that time. That's explanation number one. Explanation number two, and this is another possibility is, the bottom line is the market dropped 1,300 pips inside a month. And on the first day of December, the market then pretty much petered out. As we can see, after these three candles here, we really don't have any major active candles except for this one and this one, but there's just nothing else that shows any activity. What would explain such a thing like that? Well, institutions tend to get out of the market going into the holiday season, and many of them are getting out much earlier than you suspect. A lot of traders talk about trading is done, around the second week in, December and things like that. I actually stopped on the 7th this year of December. First of all, I made a ton of money. Second of all, I didn't need to risk any of that money. Third of all, there just wasn't that many great opportunities in the market. And so a lot of institutions are unwinding positions very early on in December. Many of them are not trading even past the first week. And so the other explanation for this from an order flow perspective would have been the market was heavily short. They unwound a lot of positions going into December knowing they had to be completely unwound. So they unwind a lot of positions. The market pulls back. And if this really was, and then I think the latter theory is the more correct one, if this really was counter-trend buying from some really heavy buyers here that overwhelmed this selling thing here, they probably would have followed it up. They probably wouldn't have just done 3 days of buying and then all of a sudden just said, okay, we're done, we gave up, we made, our few hundred pips and that's it. Why would you spend a lot of money to counteract a 1,300 pip downtrend only to push it up for 3 days so that you could bring the price back to 134? It doesn't make much sense. So what I suspect is this was actually an unwinding of positions, and because the market was massively net short, all those shorts had to exit out via buys. Because look what happened to the price action after that. After the 3rd of December, all the candles get really timid. There's wicks on both sides of the market. The bodies are really mostly in the middle. We have a couple interesting days here, but nothing really much happens after that. The market just peters out. It was very early for December. And so I think this was all the shorts exiting out their positions, and then the market just said, we're not going to take a long or short position yet. And that was it. So that's my thoughts on that one there. Now, here's the thing about it. We have a little bit of a conundrum now in terms of, and as Harley says, especially the last 2 weeks in December. Now as traders, we have a little bit of a conundrum. Why is that? Well, first off, we don't really have what I would call a natural order flow environment. We're not at normal volume levels yet. Not all the participants are back in the market. Not all the players are full bore. Some are still on vacation. You're probably going to see volume and liquidity levels continue to increase as January goes on. This is sometimes the markets will be highly active from January 1st on. There was a couple years, I remember when the Euro first rallied in 2004 up to 136, and a lot of people thought this thing was going to go to the moon, and literally the first day of trading the next year, it started selling off. The market was very, very active, and the Euro dropped all the way down to 118 that year. Many of you, maybe you remember that, maybe you don't. I've been doing this a long time, but the market was very active from the get-go. Other years, it's not like that. There's not necessarily a pattern to it, but the bottom line is sometimes the market is very active over the start of the year, and sometimes it's not. If it's not active, then we don't have that much to go on in the sense of the bottom line is it's not a natural environment. So we can't necessarily relate to this as a normal price action environment. We have to relate to it as a bubble or as an artificial environment or semi-artificial environment. So we have to take it with a grain of salt. On top of that, all of the previous price action is the result of an artificial liquidity environment because there's not even a majority of the players in it. There's a lack of players in it. So what does this mean as traders for us? It means that if we're going to be trading, at least for this first week, we want to be very cautious. And if anything, we'd want to choose pairs that are what we call in play, in the sense of they're moving very actively, they're moving very heavily, There's strong moves inside them, and we're not seeing that on the euro dollar or the pound dollar. There are other pairs that we are seeing that, but we're not seeing it on the euro and pound. The bottom line is that if you look at this here, the market opened, hit the 20 EMA, bounced up a little bit, but then it tried to make a new high and got slammed back down, and it's just kind of sitting there not too far from where it opened. So that tells you that there isn't really much market participation right now. So because of that, my suggestion right now, and this is something that I'm approaching the euro, is I'm really kind of just standing aside on the euro right now. If this was a normal price action environment, if this was, let's just assume this wasn't December for a second, then how would I interpret this price action? Then if this wasn't December and it was, sometime middle of the year or something like that, I would interpret it as a little bit differently. I would say, look, we had a massive sell-off. The market started to buy this thing back up. If the market was really going to resell it again, it probably wouldn't look like this. Why? Because when the sellers come back in, they usually come back in with force. And if they're not met with much resistance on the other side of the market, those candles should be decent in size. They should be looking similar to these or these. But they're not. The candles are smaller in size. There's wicks on both sides of the market. So if there were sellers that were actively trying to sell this thing again, saying, oh, I got this thing, get to sell this back at 134. I think this thing's going to go 125. I'll take this price and sell it again. If they did come back and put billions into the market to sell it again, then what this price action would translate into is that their orders are getting absolved by the buyers. They're getting absorbed in the sense of they're selling it, but the buyers are eating that up and they're stalling that pair from selling off. In other words, the sellers come in, they throw 30 million at the market, and the buyers come in response, say, you know what, we can match that. Or maybe we can almost match that. We'll put in 28 billion. And so, yeah, we're having a subtle downward bias, but the fact that the candles are not closing towards the lows, the candles are not big, they're small, that means that from an order flow perspective, it's getting absorbed. So if this wasn't December, then I would say, you know what, it kind of looks like euro dollar is making a bottom. A, because the sellers did come back in, they tried to push it back down, they failed to actually catch the new lows or even touch the previous lows. So that means that the buyers got more confident that this wasn't going to come back down here, and they bought it even higher because this thing stabilized here at 131, and then it went back up. Am I saying that's what's happening to the euro right now? No, I'm not saying that because this is an official environment. What I am saying is hypothetically, if this wasn't December, this is how I would translate this. We had something similar in euro over here, and I was teaching a webinar, and I said the exact same thing. I said, hey, we had this massive sell-off here, but the market then, instead of adding on new sellers, the market was trying to get short again, and the buyers were absorbing all the shorts. In fact, it was building higher lows, and they were getting more confident to buy it higher up. They weren't worried about the risk down here and having their stops below the here. They were confident enough to buy it well above this support level. That usually shows confidence on the market that the market is going to turn around. So we're seeing that same thing here. That's how I would translate this. But again, we have to trade this as a grain of salt because of the fact that this is an artificial environment and we're still kind of in one right now. So my suggestion overall in euros, step aside and let this wider range play itself out. Let this 135, almost 135 to 130 range play itself out. If you want to take a play, you can take plays around 135 to sell it or 129.70 to buy it, but I would not be buying really in between here. I would completely avoid it whatsoever. Now, one thing to take note of is that from this last major sell-off, I believe there's a Fibonacci level right around 135. Close. So we have this 38.2, which matches up here and here. The market's respecting that. It's not great fib levels, but it's decent. But the bottom line is that you may have to watch these here. So these may be your lines in the sand right now. Just things to watch out for right now. But out of all the trades out there, I don't think the Eurodollar is the best thing to be actively involved in. Again, you want to be involved in trades and pairs that are in play, meaning pairs that the market is actively participating in. Why? Because let's say the market is going to buy up and break this resistance level. If the market's actively involved and you're getting on the break, we have a much greater chance to make profit on pairs that the market is heavily involved in, because if it does break and it keeps pushing, the chances are that the extra volume and volatility will push it further, and that will give you more R, aka more reward. And that's what you're really looking for. You're looking for situations where you can really capture a lot of R. And the chances to capture a lot of R while keeping a stable risk is high volume and volatility environments where the market is actively involved. Market's not involved in the euro right now too much. So with that being said, that's why I would avoid it. Does that last part make sense in terms of trading what's in play? Yes, no? Yes, yes. Okay, here. Más o menos. Okay, great. Okay. What's the temperature in Fahrenheit? Today, I can tell you. Hold on a second. I can tell you're from the States, Harley, because you're asking for Fahrenheit. Today, right now, is about 28 Celsius. It's about 87 degrees here in Fahrenheit, roughly. But it's very humid right now, so it's pretty intense. Wow, hotter than here. Yes. Well, it's our summer. Heating on in UK 24 hours a day raised the opposite. Okay, fantastic. So let's get to a couple questions here, and then let's move on forward to some other pairs. Okay. So Chewbacca has a question. Does the price action analysis on a daily chart give the best market picture? Can we look at smaller time frames? Sure, you can look at them. I'll tell you what I do, and then I'll tell you how you can do it with other time frames, and I'll give the disclaimer that goes with that as well. When I'm looking at trading price action, I'm really looking at two time frames 80% of the time. The 4-hour and the daily chart. I don't need to be looking at smaller time frames. Every now and then I glance on the 1-hour chart, and if I really want to have some fun, I do kind of look at the 1-minute chart, but I generally don't trade off of it. I have one system that trades off the 1-minute chart, but I would say 80% of my price action trading is off the 4-hour and daily charts. And a lot of people think, and I know what a lot of you are thinking right now, which is, oh my God, 4-hour and daily charts. To trade off that, you have to have gigantic stops. It's just not totally true at all. It's just not. I have done in November and the few trades I had in December, out of all the trades I did, all the price action trades I did, the majority of them were on the 4-hour chart, and I was having stops of 30 pips. And so, there's this big fear of you trade on the 4 and daily charts and you have to have massive stops. No, you don't. If you know how to pick really good trade entries. It's not hard to do. So, but yes, as a whole, I find that price action analysis and price action trading on the 4-hour time frames, you're going to have much higher probability and result. I have 5 or 6 quantitative programs that I basically plug them into the chart on a particular pair, and then I say, perform your analysis, and it performs the analysis, and then it will give me statistics on everything you could possibly imagine. A lot of quantitative statistics, particularly just on price action. And when I do those programs and I run those algorithms on, say, 4-hour and daily charts, the statistics have very good robustness, reliability, good accuracy. But as I run those algorithms and start going down the time frames, they do not have the same level of robustness, reliability, accuracy, and profitability. And so to me, I knew that intuitively, and I knew that practically from my trading, because I've been doing this now for 10 years. Now that's 2011, I've been doing this for 10 years. I started in 2001. And I've known that practically and experientially, but to also see that from a statistical perspective just highlights it even more. To me, I'm not looking at trading as a game. I'm not looking at trading for entertainment. I'm looking at it as a skill and a challenge that I'm trying to do and do really well. And I don't really feel the need to trade more to feel like I'm really doing something or that I'm going to make more money. You're not paid by how much you make per trade, or you're not paid by how many times you trade. That's the broker. The broker's paid by how many times you trade. You're only paid by how much you make per trade. That's it. You're not paid by the hour. You're paid by how much you make per trade. That's it. Making more trades doesn't make you more profitable. And so I'm really only looking to make the best possible trades out there. I'm looking for my cherries. I take them, boom, 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 and that's it. And so because of that, yeah, maybe I'm trading less than most of you, but I guarantee I'm probably have a higher level of accuracy than 98% of the people in this room. Most of you here are not clocking in at 75+% accuracy. For the last 3 months, I had nothing less than 70+% accuracy in my trading. Nothing less. And to me, that was like, okay, that's cool. Wasn't anything unique or wasn't anything special. That's what I'm expecting to do. Why? Because I'm trading off of time frames that have good robustness to them. So as a whole, I recommend looking at the daily time frame to give you that picture. And if you want to do some trading, I recommend trading off the 4-hour and daily time frames. Once you get really good at trading price action, then I'd recommend start trading off maybe a 1 hour. But even then, it's only going to be about 25 to 30% of your trade. You have to be much more skilled to snipe the really good opportunities on the 1 hour time frames that are just so easy to find on the 4-hour and dailies. And many people think on the 4-hour dailies you're not going to get many signals. I get tons of signals. I get tons. If I was sitting behind a computer all day, every day, I could honestly trade 30 times a week. Easily. Maybe more. And that's just trading a handful of pairs. There are tons of signals. But I don't want to sit behind a computer all day. I have a life. I have things I like to do. And so I'm not sitting behind the computer just to be an ATM machine. I want to live my life. I make a ton of money. I don't need to sit behind the computer. I want to live my life. And I still wouldn't sit behind the computer, even though I know that sitting behind the computer could make me a lot more money. It doesn't matter. I still wouldn't do it. I make way more than enough to live my life. So hopefully that answers your question, Chewbacca. I recommend that. But once you get better, you can do it on the 1 hour. You can you can do these things, like these skills that I'm teaching here in this class. I apply them on every time frame, no matter what I'm looking at. Even when I do look at a 1 minute time frame, I'm still applying the same set of skills, but I just have to apply a little bit more discretion when I do that. I have to apply a little bit more criticalness to that time frame, because they're just going to be less robust and less accurate. So hopefully that's your question, Chewbacca. Okay, Trying Trader says, yes, but when would you consider it a play? And he's talking about, when do I consider something in play? Great question. I consider something generally in play when the candles are slightly larger than average. So these are candles, these blue ones right here, these red ones here, these are ones I would consider in play. I would not be trading off of these blue candles. This one here I probably wouldn't be trading off, but these candles, larger candles than usual, I consider in play. Or candles, they don't necessarily have to be large in the body. They could be very large in the wick and have a small body. But it's the size of the candles, to me, that's most important, because to move price action heavily in one direction or the other, or to create a really long rejection, aka a wick, on one side of the market or the other, you have to have a larger than average amount of volume and volatility and participation, aka order flow. So when I see larger candles, that's when I'm usually cued in to be into the market. Now, a lot of people think, oh, well, if there's a large candle, oh, well, then the move's already taken off. That's just crap. That's just not true. Just because the large candles happen doesn't mean the move is gone. I mean, if you saw this large candle and you missed this and you said, oh, well, I missed that large candle, so the trade's gone, you would have lost out on a whopping 1,100 pip potential move. You got to remember, markets, particularly currencies, tend to overshoot when they do trend. So there's a lot more opportunity for that. And really, the most profitable part of a trending environment is the middle 80%. The first 10%, the last 10% are the hardest areas of a trend to trade. So just try and capture that 80%. Don't try and capture the bottom. Don't try and capture the top. I have techniques to capture tops and bottoms, but I don't spend all my time trying to do that. When there's a trend, I try and capture that 80%. So as a whole, I know when currencies or whatever are in play when the candles are larger than average. So that's how I have an idea. This right here tells me there's no market participation, so I have no interest in that. Zero. Okay, so hopefully that answers your question. PLIU says, which pairs do you recommend trading now? I'm going to answer these remaining questions after I answer your question, PLIU, and then I'd like to go over a couple examples of what I'm looking at. I want to talk about dollar yen, and I want to talk about Aussie Kiwi, and if I have some time, maybe Aussie dollar. Okay, which pairs do I recommend trading right now? I like dollar yen, and I'll go into a chart in a few minutes as to why. In fact, yen pairs are starting to become exciting again. So, and we'll go over that, particularly because of dollar yen's movement. So we'll go over that in just a few minutes. I like Swiss franc pairs right now. They are, a lot of them are making new lows or reversing very heavily, so they're very active, very large candles. I really like Swiss franc pairs, dollar Swiss, euro Swiss, and pound Swiss. Great pairs to be trading right now. There's a lot of activity in those pairs. Aussie dollar, Aussie Kiwi, very active pairs right now. They're moving pretty heavily. So those are the pairs that I like trading right now. Okay. Next few questions, and then we're going to look at 3 charts, and then we'll wrap it up. Adrian says, what's the GMT for the price action as different brokers give different daily charts? The best way to do it is London Open if you can. That would be the overall best chart. So London Open. As you can see, like if I go to a 1-hour time frame, all these gray lines represent the London Open. And so that would be my recommendation for that, is London Open is the best. Okay. Next question. Trying Trader says, how do you pick your trade entries? Ooh, that's a complicated question. I couldn't answer that in a short period of time, and I couldn't answer that and answer all these other questions. The best way for me to answer that, because I don't just have one method for picking my trade entries, I have, just in price action systems alone, I probably have about 8 different setups. But then I have pivot point setups, and then I have shadow models, and then I have Ichimoku models. In terms of price action, I have 8 setups. I couldn't answer that in a very simplistic way, but I will answer that over a series of webinars, and I'll go over pieces of them at a particular time. Try and Trainer also says, how many good setups do you expect to see off the daily and 4 charts in a week? If I was watching the 4 on daily charts 24 hours a day all week, I could get 30 plus signals a week. On a normally good week, I could get 30 plus signals a week, easily. But for me, I get between 5 and 10. How many of those do I trade? Depends. I don't trade every single signal I trade or that I see. Various reasons. But and I'm only watching the charts. And I think there's another question. How many hours a day do I trade? 3? I trade 3 hours a day. Yeah, I need about an hour in the morning to see everything I need to see, put my trade setups. I need about an hour, 4 hours later to check on them, see if they've activated, see how they're doing, everything like that. Just to kind of get a brief idea where they're at. And then I usually need an hour in the Asian session to kind of see if there are new setups that I'll take positions while I'm sleeping. So in other words, I'll put my trades, and then if they activate in London, or to see how my trades played out during the day and things like that, see if there's anything I need to adjust and things like that. But 3 hours a day is what I really trade, max. How many good subs do you expect to see off the daily charts? And I'm only trading 3 hours a day, and I see on average 5 to 10 signals a week. But again, your question comes from the my guess is your question comes from the mentality, if I have more signals, I'm going to be more profitable. And you know what? I'm willing to challenge that theory, which is, out of all of you here, if you were to all send me your track records, I would be willing to bet many of you are trading very, very actively, and it hasn't made you more profitable. In fact, I would be willing to bet that if you slowed down on your trading and were a little more selective, you would probably be more profitable. So, just a guess, trying trader, but I think that's the mentality behind your question. Or maybe it's you just don't want to be bored, and that's fine. I don't look at trading to entertain me. I don't look at it as something to keep me entertained or anything like that. I look at it as a business. I look at it as a profession. And I'm not looking at it to get entertained. It's great and it's fun and it's exciting naturally, but I'm not looking to get entertained by how many trades they take. If I have 3 trades in a week, I'm not going to be upset. If I have 10 trades in a week, I'm not going to be that much more happy. What I am going to be happy about is how much money did I make per trade and how accurate was I. And if I traded 3 trades and I won all 3 of them, and then I compare that to another week where I traded 10 trades and was maybe only 50% accurate, I'm going to be more happy about my 3 trade week than I will my 10 trade week. Because I made money all of one week and the other one I struggled a little bit. So I want everybody, I hope you all can get away from the mentality of if I trade more, I'm going to be more entertained, exciting, this and that. This job is not to entertain you. It's about a skill that you're trying to do and do well. Things are fun when you do them and do well. Take pool, for example. If you play pool, billiards, it's a heck of a lot more fun when you're good at it. When you go skiing or snowboarding, it's a heck of a lot more fun when you're good at it. The learning process for me in snowboarding was slow, long, and painful, and it was fun and interesting all the way through, but it was a lot more fun when I was good at it. A, because I wasn't falling and hitting my face on the mountain, and B, I was actually, when you do something well, it feels rewarding. That's its own entertainment. So that's my thoughts on that one there. Okay. 6 more questions and then 3 charts. We're going to do it in 10 minutes. Harley says, do you use IntelliCharts for your trading or use other platforms? I use IntelliCharts for all my trading, save for I have some EA alerts that are only run in MT4. So what I do is I have an MT4 station running on the side. It's just minimized, and then it makes an alert when one of my price action formations came up, and then it says ring, and then I go check it out, and then I either make a trade or I don't. So, but the majority of all my trading is done off IntelliCharts, yes. Boyke says, do you prefer larger or smaller candles? I prefer larger candles. However, there are unique small candles that will clue me into a trading opportunity, but the majority of all my trades are made to trade off of larger candles because that means there's active volume and volatility from the market, which means that I have a greater chance of making money off it than I do off of smaller candles. So hopefully that answers your question. Chewbacca says, is ATR a good indicator to determine big, significant candles? Not really. You can use it as a starter, but eventually you can get rid of it. Eventually you can just learn to see it visually. I would say instead of using ATR to do that, I would say look at the visual aspects of it. Look at, this candle in relationship to these candles, or this candle in relationship to these candles. So just take a general kind of gestalt look at it and at the chart, and then just say, okay, what are the average size candles as a whole, and then what are the current candles like? Are they bigger than those or smaller than those? During this move, they're all very large, so that means I want to be very actively involved. So hopefully I answered your question. That's something you can learn very quickly if you just practice it visually. Lindley says, Does it count whether the broker time differs? As in, let's say the broker's time is EST versus broker in GMT. Their delays and 4 candles will differ. Does that affect price action at all? Yes and no. I've run the models, my quantitative models, on brokers that have, I've run the models on brokers that have their charts based on GMT time, European time, which is 1 hour ahead of GMT. I've run them on models based on New York, and the statistics are not that much different. We're only talking a couple percent. And so, in fact, I even ran it on one that was based on Australian time. And so, with that being said, you have a slight, and I mean slight statistical edge if you trade these price action formations off of GMT, but it's a very slight. We're only talking a couple percent. So I actually haven't found that much difference by trading them off of a different time frame. But if I have my choice, always GMT if I can. So hopefully I answer your question. You always says, do you use any indicators at all? When I'm trading price action, I just use one indicator, that's the 20 EMA. And in the next class, and even a couple, when I go over the 3 charts in this class, we'll explain some of that and how I use it. Rex says, so you don't listen to news? No, not at all. I couldn't care about that at all. I spent years listening to that, and it was a complete waste of time for me. The only pieces of news that I'm interested in are interest rate decisions, NFP, and central bank interventions. Other than that, I don't care about news at all. And it hasn't affected my trading at all whatsoever. In fact, my trading's been better since I've been away from the news. Trading Chair says, do you always wait for the pullback? That's it. If I'm trading reversals, not necessarily. There are times where I have price action systems that will call tops and bottoms. So no, not necessarily. In fact, I'm not always trying to trade reversals. Sometimes I'm trading with trend moves. And I wouldn't wait for a pullback. TB says, what do you recommend for someone who wants to learn your technique? Where to start? It's a great question. I would say, A, keep coming to this class. B, at the end, I'll give my website. I have a ton of free articles on how to learn these techniques. C, check out all my videos on price action. And then D, after that, if you really want to take it to the next level, I have an advanced course that can do it. We can talk about all that later. But I'll make sure to give you all the information on where to start with that. But this class is a good place to start. Last question, and May's question. May, can I ask your question or answer your question? And yes, TB, all the videos are on my site, and I'll show you. There are specific videos you want to look to, so specifically on price action, because I have videos on everything. So, but May, if I can't answer your question, let me answer your question at the very end of the class. I want to do 3 charts in 5 minutes, and we're going to do it. Okay, number 1, dollar yen. Talk about why dollar yen is such an interesting chart to me. Okay, so dollar yen, and I think I wanted to look at it on the 4 hour. That's what I wanted to do. Okay, real briefly, I'll give a brief summary of this here. Dollar yen was selling off for a long period of time. Bank of Japan intervenes, tries to create a two-way market. Everybody recognized, hey, and this is something I even announced in the class. After the market normalizes, the market's going to sell back off. Why? Because the same underlying reasons that were causing the dollar yen to sell off are still present. One central interbank intervention is not going to do it. In fact, every central interbank intervention from dollar yen has always resulted in the pair continuing on in the direction they didn't want it to go. Same thing with Swiss franc in 2010. They tried to intervene, sell the Swiss franc and weaken it, and it kept getting stronger and stronger for quite a long time. So it continued to sell off, but then the market bottomed around 80, and we saw, remember what I said about a changing of hands? Candles are starting to get smaller. We're now seeing blue candles start to really intermix with the red. Before it was all red, now it's blue. Market changes hands, becomes a predominantly blue market. Then, after sealing around 84.50 and struggling there, the market sold off very aggressively in the end of December. And instead of making it back to the prior lows, it goes 100 pips shy of that, which means that it's possible the buyer said, you know what? We feel confident buying at 81. We don't feel this thing should be back down here. We think it's undervalued over here. We're going to get back in at 81. We're going to buy this thing back up. And we can see that on the 4-hour time frame because the market had a very clear relationship. Once it started selling off again, and take a look again. Let me zoom out. So we had several attempts to really break this 84.50 and just couldn't do it. then the market, if you look at the candles, they start to go from more red to blue, or more blue to red, and then they become very predominantly red. But look at the market's relationship to the 20 EMA. Once it really settles below it and treats it as resistance, boom, it never comes back to it again. It just sells off and pulls away from it. And then the first time, look what happens when it hits 81. Hits here, stops. This is now the new year. The market buys it off the 81 lows, and look what happened since then. We had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, not including this candle. We had 8 out of 10 buying candles on the 4-hour time frame, aka 32 out of 40 hours of straight buying. The pair climbed about 130 pips, a little bit more in that short period of time. That's some aggressive buying off of dollar yen, and it was the first time it broke above the 20 EMA. So this 20 EMA, which was resistance, dink, 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 and dink, has now been taken out. So my guess is that the market is really trying to build a base for dollar yen. That means there might be a potential buying opportunity off of 81 if it comes back again, with stops just below 80. We'll have to see how it relates to between here and then, but dollar yen is a very active pair right now. There's more activity in dollar yen than there is in euro dollar. So based on this massive sell-off, based on how the 4-hour it was below the 24-hour or the 20 EMA and then broke back above it, is telling me that the market is a little bit interested in buying dollar yen at these lower prices. So keep an eye on that. Another pair that I think is a good one to keep an eye on is sterling Swiss. Why? And I'll show you. Sterling Swiss, in case you don't know it, these were all-time lows. In its entire history, these were all-time lows against it. And so it broke back below 45, has been aggressively selling off leading in through all of December. It's been selling off pretty much all of 2010. But then look what happened here. It's done something interesting. Massive selling candle, closes towards the lows. The market opens. It doesn't even sell off more than 14 pips and then gets bought up pretty strongly. Then the market opens, sells off again, closes towards the lows, but this is a higher low, and then the market says, guess what? We're more comfortable buying this off the lows again, even though we're not near the lows, we're off the lows by 60, 70 pips. We feel that this thing is stronger, aka higher lows, and look what happens. They have more confidence, and they launched this pair up 325 pips in one day to start the year. So to me, that's very interesting that after such an aggressive downtrend, using the 20 EMA as resistance, the pair was bought up around this 144 barrier, 2, 3 higher lows, closing towards the lows, buys up, and now buys up aggressively. To me, this could be a sign of a bottom in place for sterling Swiss. And as we can see, had a relatively close relationship to the 20 EMA, and it's now completely taken that out. The one thing that's also concerning for me about this selling pressure being done is that the market sold off, pulled back a little bit, made new lows, pulled back a little bit, made new lows, pulled back a little bit, and instead of making new lows, it made a higher low and then broke back into this range. Generally, when the market sells off, makes new lows, sells off, makes new lows, sells off, makes new lows, but then buys back up and breaks back into the range, that usually means that it's usually what we call a breakout failure. And that breakout failure can often be the sign of the end of a trend. Also take a look at this. These two candles right here gobble up how many candles before it? A lot. So this is what we call in play. It's very aggressive. The market was heavily involved in buying sterling Swiss. So to me, this is one of the more interesting pairs to be trading right now. So hopefully it gives you a question. Maud and everybody else, I know it's past my allotted time. Is there another class after this? Should I be wrapping it up, or can I finish one more pair and that's it? I'll leave it up to you. So while waiting for Maud, please puts in another pair. No one after. Okay. I have enough time to do Aussie Kiwi, and then I got to wrap it up, because I have things I have to do today. Okay, Aussie Kiwi. First off, just want to blaze through this and take a look at the larger picture. Many of you don't have 30-year data on pairs. Luckily, I do. In case you didn't know it, the Aussie used to be very highly valued against the Kiwi, all the way at 176. It then embarked upon, over a 3-year period, a 7,000 pip decline, where it found a base at 105. After bouncing a little bit, it found that same base at 105 and was a great buying opportunity. The market bounced again, and then it sold back off over a 6-year period and hit 105 again, where it found support again, and then has now started to make higher and higher lows. Now, if you look at this most recent structure, obviously 105 is a great place to be buying Aussie Kiwi. We're far away from that. I was trading back here. I did do some buying of it way back then. In fact, I was very heavily trading Aussie Kiwi in 06 and 07. One of my favorite pairs to trade back then. But if we look at this most recent structure, take a look at how the pair makes new highs, makes a higher low, makes new highs. This is the 2008 crash there. Take it with a grain of salt. Market recovers, finds a ceiling here, makes a higher low, finds a new ceiling, makes a higher low, keeps building up and building up. All of this is telling me that the market is really trying to build a base in Aussie Kiwi and take a pair higher. You know, that 105 really is a legitimate bottom, and that this pair probably is going to continue to make higher and higher grounds against it. With that being said, we have to take a look at this massive downtrend and look and see why it was rejecting so long. Well, take a look. Boom, boom, boom. Bottom line is it has not been able to have a monthly close above this Fibonacci level. But as we can see, look at all the price action pressure. Every time it sells off, it gets bought up higher. It doesn't make it all the way down back to the previous lows. It gets bought up at a higher price. The market is happy to buy the Aussie on dips and push that thing higher and higher. Instead of this being the resistance, which it was before, now it's floating with these levels. My suspicion is that eventually it's going to break this fib level and that it's going to really make its way into higher ground. If it does do that, if and when it does do that, I think we got a nice move back to 135, but then a likely move back to 140.65. And so from a long-term perspective, many people don't look at the Aussie Kiwi. Many people don't even look at charts this big. But the bottom line is that I suspect Aussie is going to continue to gain ground against Kiwi in 2011. I think this is going to be one of the better pairs, and understandably so. As long as gold continues to surge, as long as there's, continue to be strengthening economy, interest rate increases on the Australian Central Bank and things like that, I think I can't see any reason why the Aussie won't continue to gain ground against the Kiwi, and the price action shows that. And so, with that being said, I think this is one of the better plays out there. How would I trade it? Simply wait for a monthly close above that fib level that I talked about. That would be option number one. That fib level is at 30.28 if I'm correct. That would be option number one. So 31.70 through 3,200. Wait for a monthly close above that. Your next major resistance level is 35 and then 140. So you got about 800 pips to play with there, and you don't need a very big stop. That's a massive potential there. This thing could even go much further than that. It could go up to 145 and beyond. I think eventually the Aussie will continue to gain ground against the Kiwi. So that's the way I would really be playing it. Or you can wait for pullbacks to just below the 20 EMA, 127, 128. That's the way I'd be looking at it. But I'm really looking for a close above this fib level, because I think once that happens, this market will continue on up at that point. So that's my thoughts on that one there. Okay, I have to get going. I'm looking at some new flats today. I'm buying some new property in the next month. So I have to get going. But I want to thank you all very much for coming. I hope you guys enjoyed this webinar, and I will be teaching this every single week for a long time now, hopefully. So thanks to FX Street for hosting. Thanks for everybody for coming. Have any questions about what I do, services, things like that, secondskiesforex.com. Check us out. For the one who wanted to, I think it was TV, who wanted to look at that. And May had a question. And on that website, you'll find a ton of videos, ton of articles on price action. Please check it out. Ton of information there. And then for May that had the question there about the Pro Forex course, May, email me at info@secondskies.com. Yes, there's still seats available in January. So that's very much it. I thank you all very much for coming. It was great seeing you guys here. And yes, this webinar was recorded, so you will be able to see it soon from FX Street. Keep an eye on that. Until then, good luck trading. I wish you all the best, and I'll see you guys next week. Take care, everyone.